Hello, everyone, and welcome to the IEA Africa University. My name is Rita Madeira, and I'm Africa Program Officer at the International Energy Agency. I'm very pleased to have you all with us today to hear about IEA's latest analysis on this year's investment trends in the energy sector. For those who might not be familiar with the IEA, this agency is an intergovernmental institution at the heart of the global energy dialogue and transitions to a clean energy future. For nearly 50 years, the IEA has been collecting data from countries and partner institutions and providing stakeholders throughout the world with impartial, unbiased, and reliable analysis and information covering all fuels and all technologies. The IEA covers three core areas of work. First and foremost, data collection, and thanks to the national energy balances that you provide to us, the IEA is able to share energy statistics broadly. The IEA is therefore pleased to continue working with you and discussions with you on how to collect, treat, and make statistics more reliable. Secondly, the IEA focuses on providing policy advice to policymakers. The IEA often convenes high-level summits and other international fora for dialogue among peers, notably to discuss top priorities for the global energy agenda. And last but not least, the IEA supports the implementation of these policies towards a more secure, clean, affordable, and sustainable energy future. The IEA University is an initiative that started with the support of the European Union as part of a broader capacity building program on energy statistics and modeling for 10 sub-Saharan Africa countries, which provided a good platform for country-specific training, peer discussion opportunities, and bilateral work on energy data improvements and modeling practices. This initiative continues and aims to provide regular updates on IEA's body of work and analysis, particularly through the lens of how global movements in the energy sector can also impact sub-Saharan Africa. It is also a good opportunity to stay tuned on topical areas and developments in the energy space, and we are very pleased to count on a regular audience of experts and practitioners, as well as sporadic participants who are interested in specific topics. But today, we hope that we're going to address a topic that will interest everyone, and particularly energy experts in the African continent, and that is investment. Investment is a key enabler for the adaptations to the energy systems that need to happen worldwide, and that regardless of the specificities of each region. In addition to energy flows, the International Energy Agency has therefore been tracking investment flows in the energy sector for the past few years, and this across all fuels, technologies, and regions, and has been issuing a yearly report on world energy investment. This series has always provided an important benchmark for tracking capital flows in the energy sector across the world, but in the current context of high fuel prices, inflationary pressures, and supply chain bottlenecks, which is a context that creates a potent mix of pressures and incentives for energy investors, this report could not be timelier and more relevant. Benchmarks provide important information and a heightened lens through which to look at trends and potentially spot points of concern. Investment trends in recent years have contributed to the crisis that we see today, and the IEA has previously highlighted shortfalls in energy investment and the possible implications for energy markets, security, and emissions. This year's report examines how investors are assessing risks and opportunities across all areas: fuel and electricity supply, critical minerals, efficiency, and this against the backdrop of uncertainties over how events will play out in 2022. But to hear more in detail about the key findings of this report, I have with me my dear colleague, Emma Gordon, an energy investment policy analyst, who will walk us through the main themes of this analysis. The report can be downloaded on IEA's website, and after Emma's presentation, we'll be happy to take any questions that you may have and that you can type in the chat function or the Q&A function. So without further ado, let me hand over to Emma to walk us through the key findings of the report.
Okay. Thank you, Rita, and thanks everyone for joining us today. So as mentioned, what I'll be talking through here, rather than our analysis on the energy flows, is really on capital flows. So to start out with the big picture, taking everything into account of investment in power, fuel supply, efficiency, and end use. So energy investment is set to pick up by about 8% in 2022. And reach $2.4 trillion against the backdrop of the global energy crisis. Investment is increasing in all parts of the energy sector, but the main boost is really coming from the power sector, specifically in renewables and in grids, and also from efficiency spending. However, more than half of the increase in capital spending is actually linked to higher costs. So costs are rising due to the multiple supply chain pressures that Rita mentioned, tight markets for specialized labor and services, and the effects of higher energy prices on key construction materials like steel and cement. And it's really concerns about cost inflation that can act as a brake on the willingness of companies to increase spending despite these strong price signals. Now, let's just look at clean investment. So renewables, nuclear, energy efficiency, infrastructure, low carbon fuels, and electric vehicles. After flatlining for several years, investment in clean energy technologies and infrastructure is finally stepping up, with renewable power, efficiency, and EVs really leading the way. So clean energy investment grew by only 2% per year in the 5 years after the signature of the Paris Agreement. But since 2020, that annual growth has risen to 12%. Spending has been underpinned mostly by government fiscal support, especially in advanced economies. And renewables, grids, and storage now account for more than 80% of total power sector investment. Efficiency investments are led by spending on buildings, driven by higher fuel prices and government incentives. And rapidly rising EV sales are also a key contributor to higher clean end-use spending by consumers. Now, not particularly visible on this aggregate figure, but there are also signs of life in some of the smaller categories. So some of the emerging technologies, notably batteries, low emission hydrogen, and CCUS, carbon capture, utilization, and storage. And that really gives an indication that it is possible that the crisis that we're currently facing could be a moment for innovation and bringing new technologies into the system at scale, as was seen with nuclear power in the 1970s. Now, one of the big caveats to this generally upbeat message is that there are major regional variations in clean energy investment trends. And this points to the risk of new dividing lines in energy and climate, with developing countries potentially being left behind. So the rise in clean energy spending is concentrated in advanced economies and in China, and in other emerging and developing economies, including across African countries, the investment remains stuck at 2015 levels. Now, in emerging markets and developing economies, public spending tends to account for a much larger share of energy investment than it does in advanced economies. And at this time, public funds are limited to support sustainable recovery. There are economic clouds on the horizon, or well, gathering already, to be fair, notably inflation and high debt levels, and high cost of capital and rising borrowing costs threaten to undercut the economic attractiveness of capital-intensive technologies, such as clean power. So to give you an example, an increase of 2 percentage points in the cost of capital for solar PV and for wind can lead to a 20% increase in overall levelized costs. And this is particularly concerning for countries in Africa, where costs of capital are already much higher than in Europe and North America, and they can actually be up to 8 times higher than in those economies. But surely, globally, we have the money to pay for this spending, and that's clear within sustainable finance. So how can we help bridge the gap here? And perhaps sustainable debt issuances can play a major role here. Sustainable debt issuances reached more than $1.7 trillion in 2021. And these can act as a very important tailwind for renewables in particular. And there's huge potential to harness these sums to support the needs of energy transitions. But again, the rise in sustainable debt is not well correlated with clean energy investment, particularly because of the concentration in advanced economies. So much more needs to be done by governments, international development institutions, and private investors to bridge this widening gap between regions and to support the pace that we need to see of energy transition investment. So I'll turn now to fuel supply. And the key message here is that there's a response to higher prices, but also some hesitation, which is really important for African governments that are hoping to produce oil and gas in the future to factor into their strategic planning. So overall, upstream oil and gas investment is rising, but higher costs explain a great deal of that. So still around half the levels of, we're still at around half the levels of 2014 spending and well below pre-crisis levels. A lot of that is policy and price uncertainty, which remains high, and financing can therefore be difficult to secure, with many companies generally shying away from large commitments of capital that may take many years to pay back. And we also need to keep an eye on what's going on in the coal markets. So investments in coal supply are picking up, especially in emerging Asia, in response to energy security concerns. So coal supply investments rose by 10% in 2021, and another 10% increase is anticipated this year. This increase is primarily being led by China and India, who are the two dominant players in the global coal markets. When we look at refining, the refining sector saw its first reduction in global refining capacity in 30 years in 2021, as 1.8 million barrels a day of retirements outpaced relatively modest additions in China and the Middle East. This has contributed to an extraordinary rise in refining margins seen during the crisis in 2022. However, the strong financial performance and high utilization rates seen in recent months may not necessarily translate into higher investment levels, given lingering uncertainty around the long-term outlook for oil demand. When we look at LNG, we can see that Europe's move away from Russian gas is now putting new demands on LNG markets, but the implications for new LNG investments are complicated by the fact that most projects face a 3 to 4 year construction period and payback periods for invested capital that go well beyond the immediate European scramble for alternative supply. So the uptick in long-term LNG commitments is still being led by Asian buyers, and only 2 new LNG projects in Australia and in America have so far taken final investment decisions since gas prices started rising in mid-2021. And finally, looking at low carbon fuels. So here we see that low carbon fuels are set to get a boost from higher fossil fuel prices, but the largest item here is biofuels. And the upside here is complicated by the ongoing food crisis and the potential for competition between land use for first generation biofuels and agricultural output, which is likely to act as a brake on investment going forward. So let's look a little bit more closely at the strategies of different oil and gas companies, since they vary quite widely. And what you can see on the figure here is that the change in investment since 2019, so since before the COVID crisis, and we'll first look just at traditional investment in oil and gas supply. So Middle East NOCs, national oil companies, their spending is now well above pre-crisis levels, as major resource holders look to bolster dwindling spare capacity. But this is the only grouping for which this is true. Russian companies had also announced large increases, but these are not likely to come to pass. Among the Western and international companies, the US majors are planning to increase oil and gas spending considerably in 2022, but this indicator is still down on the figure that we show here, looking at a comparison to 2019. Given that the emphasis so far this year has been still on capital discipline within shale producers rather than expanding production. Now, if we add on spending by oil and gas companies outside of their traditional areas, then the picture changes quite dramatically. In practice, the European majors in 2022, together with Equinor, are the main drivers behind a rise in spending by oil and gas companies in clean energy, especially in offshore wind. And clean energy spend now accounts for around 5% of total oil and gas company capital expenditure. I also want to touch on critical minerals, since this is the first time for an integral part of the world energy investment analysis. So what we're looking at here is how a surge in input prices over the last year has been a major factor in reversing the long-standing declines in the costs of clean energy technologies. So columns here represent the annual changes in cost for solar panels, wind turbines, and batteries, plotted against the lines which show the correlation with rising costs for silicon, steel, and lithium, respectively. Market tensions are exacerbated here by Russia's increasing isolation. So Russia is one of the leading producers of palladium, aluminium, and battery-grade nickel and cobalt. Elevated prices are bolstering revenues and investment. The combined operating profit of 18 major mining companies that have a strong presence in developing energy transition minerals has more than doubled in 2021. In contrast to the hesitation just described with fossil fuels, elevated critical mineral prices are accompanied by expectations of rapid demand growth, and this helps to underpin expansive investment plans. In the African context, the picture is slightly different. So despite the massive resource potential, exploration spending in African countries fell sharply between 2012 and 2016 and has remained stagnant since then. However, a lot of this is really driven by hurdles such as the quality of geological surveys. And if African governments can reduce these hurdles, then revenues for metals such as copper and key battery metals, which Africa currently represents about 13% of the global market, could double by 2030. So what does this mean for energy security and our climate goals? As ever, we benchmark today's spending against the amounts required in our various different scenarios, which will be shown here. There we go. So investment to bring more clean and affordable energy into the system is rising, but is not yet rising quickly enough to forge a path out of today's crisis or to bring emissions down to net zero by mid-century. Anticipated spending of $1.4 trillion on energy transitions in 2022 would need to rise to well over $4 trillion by 2030 in order to get us on track to cap global warming to 1.5 degrees. The amounts required to get us on track for the pledges that countries have actually made, so those at COP26 and elsewhere, are lower, but we are still talking about a doubling of spending on transitions worldwide. The deficits in spending are visible across the board, but are of course particularly large in emerging and developing economies, as highlighted with the regional divergences we discussed earlier. Now, if we look at spending on fossil fuels, aggregate spending on fossil fuel supply is roughly aligned with where it would need to be in 2030 in a scenario that hits the world's climate pledges, although with reductions in coal supply and fossil fuel power generation. It, though, remains above the levels required in a 1.5 degree scenario. So no one should imagine that Russia's invasion can justify a wave of new large-scale fossil fuel infrastructure in a world that wants to limit global warming to 1.5 degrees. So the key message from our investment analysis is that something needs to change for us to find a way out of today's multiple crises. From the perspective of the IEA, the answer is very clear. We need to have an acceleration in clean energy transitions, and that means a surge in spending across a range of technologies and infrastructure. These are the lasting solutions that can move us to a more secure and sustainable energy future. So finally, to end on something particularly relevant for this audience, where can we find some of this much needed investment when we're looking at African countries in particular? In our Africa Energy Outlook, which was a report we also published in June, we looked into the role that climate change related finance can play on the continent. For example, advanced economies pledged to provide and mobilize $100 billion of climate finance to developed economies annually. Based on the latest available data, which was from 2019, advanced economies are shy of this target, achieving only 79 billion. And of this, only 7% went to the energy sector in Africa. As with international concessional capital more broadly, climate finance is well suited to expand beyond renewables projects to support some of those harder to commercialize activities and to de-risk new markets. However, it must do so without increasing country indebtedness, while tightly focusing on mobilizing private capital. And this is really likely to require a shift towards cost-reducing grants and equity finance, rather than the current over-reliance on debt instruments. Equally, following the finalization of Article 6 of the Paris Agreement rulebook at COP26, international carbon markets can also help African countries receive further foreign investment to develop mitigation projects. So countries can trade internationally transferred mitigation outcomes, ITMOs, under Article 6.2, and they can also issue carbon credits in a new international carbon market that will be governed by the UN framework Convention on Climate Change, the UNFCCC, which is known as the Article 6.4 mechanism. Sorry. Estimations of Article 6 potential in African countries indicate that by 2030, these mechanisms could generate between $225 and $245 billion in net financial flows to countries, as well as prevent the emissions of around 22 to 24% of Africa's total energy-related CO2 emissions. However, work needs to be done by various stakeholders before this can be achieved. And the details of the implementation of the rules, modalities and procedures of Article 6 are still being finalized at the UNFCCC, and countries will need to translate them into legal frameworks that can govern the ITMOs and carbon credits. Maximizing the available sources of capital will be vital if African countries are to achieve the doubling of energy investment by 2030 that we see under our Sustainable Africa scenario. And so with that rallying call, I'll open for any questions that you might have on the analysis.
Feel free to ask questions. We're still waiting for this shy audience to come forward. Still no questions. We'll give it a little bit more time. I guess there was a very clear and comprehensive presentation. We have Denia Nyaraluga from Mozambique saying good morning. Denia, if you have a question, please feel free to ask it. And good morning. Okay.
Sure. So
maybe let's just read the question on that. So the question from Denia, I would like to know if there is a methodology in Excel to collect energy data investment as energy data statistics. We would like to collect more organized data, but we would like to have a guidelines internationally acceptable.
Yeah, so thank you very much for the question, Denia. So we have a methodology that we use for our energy investment modeling and for our collection, and this is something that's publicly available, so we can certainly share it with the group after this call. But it isn't really necessarily, I would say, a standard. Really, what we're looking at is, for us, we look at capital spending, and we base that on a variety of different factors depending on the energy type. So data that's available can vary quite significantly for example, oil and gas versus power sector, and it can be quite patchy, obviously, in certain markets. Some of these investments will be private, so the details won't be released. So then we do also have a modeling element. But the methodology certainly contains a lot more details of that. So that's something that we're happy to share after the session, and it can give you an indication of the different sources that we use. For some of the inputs, we do rely on other data providers, so private companies that track infrastructure spending, so big names, people like sort of Preqin or Bloomberg. But yeah, then I said it, as I mentioned, additionally, we do have our own internal modeling that we use for any gaps in the data, but happy to share the methodology to provide more details.
Thank you very much for the question. If there is any other question before we say goodbye for today. I think we are ready to start wrapping up. Any final words you'd like to say?
No, other than, thank you very much for your time. I know this is something that's oh, sorry, we can see a hand up.
We can see a hand up.
I'm referring to the earlier presentation.
That's for questions. So, Abubakar Sambo, over to you to ask the question.
Yes, that's right. Actually, my question is to Rita. The presentation you made earlier regarding I was thinking there's a lot of campaign for nuclear power, but I was surprised to see investment in nuclear power is very little.
Sure. Oh, sorry, we can hear quite a lot of echo. Hi, maybe this sound is a little better.
Did you get me?
Yes, we had the question. Can you hear me okay?
Very well.
Okay, great, thank you. So firstly, thank you for the question. As I understand, you're asking about the level of investment in nuclear. Generally speaking, nuclear can be quite controversial in a number of economies. So it's a bit of a challenging subsector because, as you'll be well aware, there is a lot of resistance in some areas, particularly around the environmental impact and obviously safety concerns. And so nuclear does still represent quite a small portion of clean energy investment, of power investment, but it is obviously an important part of the modeling. It's an important part of clean energy, obviously acting as a baseline power. So we do see it still playing a role, but because of those other pressures that it faces, as I said, particularly around the environmental concerns, it is still a relatively small share compared to some of the other figures. And I could mention, I believe we actually have a special report on nuclear, either that may have just been released or coming out later this year. I have to admit, I can't remember the exact date, but that can also have a lot more information on our forecasts for the sector.
Yes, no, it was actually, I think it was recently released. I don't know if you can hear me well. It was recently released, so we would invite you to go to our website and download it because you can find much more detailed information. But indeed, I think one of the key findings of that report for the IEA was that for the countries that already have nuclear, and this is really an important option to continue developing to achieve those net zero goals globally.
Okay.
Thank you for your question. I don't know if there's any. We invite you to mute yourself, please, Abubakar. Thank you.
Yes.
And we'll maybe just give it one final minute. If there's anyone else who might have an additional question, please feel free to tap it into the Q&A or just raise your hand and ask it directly to the audience, to the group. Okay, I think might be time for us to wrap up then. Well, thank you everyone for joining. We hope we found this interesting. The video will be available in IEA's YouTube page. You can go there and listen to it again. You can go to our website for additional resources. And thank you very much for your interest, for your time. And we look forward to seeing you again.